Oh, thank you so much. All right. After. Let's do after. Okay, so the sixth one, we'll try to do chapter 23, finish 22, and do as much of 23 as possible, so that we have at least a lecture or maybe more for the preparation of the exam, right? And then you also will have an extra credit. Okay, so objective 16, oh, 6. What we learned today, we'll learn how to prepare performance report for responsibility centers. Question? Okay. And account for traceable and common shared fixed costs. Oh yeah, okay. Let's start here. Okay, so what do we see here? This is your partial organizational chart. Okay, so we have different information coming to CEO. So let's look what's happening here. We'll be talking again today about the Smart Touch company. And so in a company like that, we have different assignments of responsibilities to each of the parts of the organization. So at the top level, we have our CEO. Okay. Yeah. All right. So what does he do as CEO? CEO oversees one of these three, all of these three divisions, right? So we have VP for CDs, responsible for CDs, right? VP is the vice president. Then we have VP for DVD divisions and for e-learning divisions, right? So we have all these division managers. They have quite a broad responsibility. So on the example of the DVD division, we see that they also incorporate two other positions, right, that feed the information to our VP of DVD divisions. That's manager who oversees Excel DVDs and then manager for specialty DVDs. And we'll look at the, on the example of our statements, we also saw that the DVD can be of two types, Excel and specialty, right? So for each type, we have a separate manager. Okay. So all of these managers, right, and let's call a CEO also as a type of a manager. All of these managers, they have different responsibilities. They are responsible for maybe increasing return on investment or maybe something else. So let's look at who is responsible for what and what is this responsibility accounting. Why are we talking about responsibilities? So responsibility accounting is your system for evaluating the performance of each responsibility center and its manager. So what would be a responsibility center? A responsibility center is such a part of your organization where a particular manager is responsible for usually something corresponding to a product or a function within the organization. So it's a part of the organization for which manager has decision-making authority, right? But not just an authority, he's also accountable for all the decisions that he's making. And therefore, we have four types of these subtypes of the system. So we have a cost center, revenue center, profit center, and investment center. If you think about it just for a second, our lower level managers are often responsible for simple budgeting, right? They are usually, those managers are usually responsible for some control of costs and such. So it's very low level control of the budget, okay? Just an example of the lower level. We'll talk about it in a second. So let's talk about these responsibility centers in just a little bit of detail. So our first type we said is a cost center. So usually that cost center is the, and a good example of such center would be your line of production. So it's a production line for CDs in our case, right? And here our managers are just going to be responsible for costs. Okay, so their goal is only to control the cost. That's it. That's the lowest level, right? So let's go next. The next we said is the revenue center. So for the revenue center, for example, our sales region. In our case, let's call it, we have a Midwest sales region, or I don't know, South West, or whatever that is, the other sales region, whatever is the mapping of the subdivision of the company. So here, our managers are going to have a little bit of a shift in responsibility. They will be also generating sales. They will be responsible for generating the appropriate amount of sales, right? So going up, we have a distinction in responsibilities, right? So what would be their goal? Is to increase the revenue, okay? So the third one is our profit center. Profit center for a particular, for example, line of product, a particular line of producing that Excel DVDs or whatever that line of product is, there are managers who are responsible for revenues and for costs, right? So here the goal a little bit changes. It's an increase in profit. All right, and so the last one is the fourth, our investment center. So that would be such as for CDs, DVDs, e-learning divisions and such. We have managers who are responsible for investment revenues and costs. Okay, so we have the difference here is the investment, right? We have the same practically goals, but we also add the investment here. And the same if you look at here, we have costs and we have here sales revenues. And here we have an addition of both, right? So how does it change? Once I have to review one of my managers, what am I going to do? So if I am in a position to review my centers, the head of my each of the centers, what am I going to look at? So for the cost center, where the goal is to control costs, I will give a more favorable review if my costs are less than the budgeted. My actual costs are less than budgeted, right? Because I want that manager to be interested in controlling costs. So for the second one, which is the revenue center, if I have to give a review, the more favorable, because the goal is to increase the revenue, the more favorable evaluation if the revenue is going to exceed the budgeted one. Okay? For the third one, which is a profit center, given that the rest is all equal and everything is good with the production, the manager that I'm reviewing will likely get a better review if the actual profits are going to be exceeding budgeted, because my goal is to increase the profits, right? And then the fourth, which is an investment center, because my goal is to increase both the ROI, EVA, and the residual income. What I'm going to do, I will give the better review if it's greater than what I budgeted, right? Again, I will be comparing my budgeted with the actual numbers and make a distinction whether or not my managers are performing well. All right. So therefore, what would that report? How would I identify whether or not my manager is doing well? I have to have some system for reporting in place. So performance reports, they compare the actual to budgeted numbers, and the reporting is usually done on all possible levels because I want to find the weak link, right? So I'm going to look at the investment centers, right, my division, production lines for my profit centers, my production, which are my cost centers, and the sales for the revenue centers. So I'm going to be looking at reports on all levels. These reports are also going to be used not just by the immediate management, but the CEO is also going to look over and decide how do I evaluate these divisions? What priority do I give to these divisions? While my VPs are going to be evaluating just the lines of production, right? We said that the structure CEO and right under a VP, so VP is going to be evaluating the production lines. As a CEO, you would be looking at the production itself overall, right? All of the divisions. All right. So I will put in place my management by exception, where I'm going to look at the variances between the actual and the budgeted numbers. So let's check. Let's look at this. Which of the following managers is responsible for both revenues and expenses? So is it my investment, cost, profit, or revenue? Good job. All right. So let's look at some of the departments. In most companies, there are departments that provide services for multiple departments and multiple divisions of the company. So our service department is a department that provides services to multiple departments or divisions of the company, and usually they do not generate any of the revenue. They're similar somewhat to our shared production overhead. Okay, so it's a shared, right? It's not going to be assigned just to that particular department. And sometimes we call them non-production related service departments. Okay, that's as an example. So what are those? That's our human resources, right? They're servicing usually the whole company. Okay. Accounting is another example. Copying, graphic services, physical plant, right? That requires some maintenance, for example, that maintaining not just that particular line of production, but they're servicing the whole plant. Mail and shipping services, shared facilities, legal facilities, and travel booking services. So this is obviously not an all-inclusive service list. So the key here is that a service department is really centralized, right? They're not generating any revenue, and they provide services to many departments within the company. So while we're discussing this department, right, service departments, that are not really generating any revenue, nothing really, you can't really say that it relates to a certain production line or a certain product that I'm producing, right? I still have to have this notion of traceable fixed costs. So what am I going to do here? And what are these traceable fixed costs? They are costs that are directly associated with an individual product, division, and business or business segment. So the key here is to try to identify how do I determine if this cost is traceable to this particular product division or business assignment or to another one. So how would I go about this? So the first, what I would notice, if I were to discontinue that division or a product, they would disappear if the company makes a decision to do so, right? So how would I assign those traceable fixed costs? First, if I were just to split throughout, that wouldn't really look fair, right? And more than just fair, it would make my accounting off, right? So what I'm going to do, I will probably split it based on the usage, okay? So based on my usage of these services, that sounds like fair, and that sounds more than anything like something we've done, right? So those users who do not utilize this these services are going to be charged less, and those that do are charged more. Okay. So as you remember in our ABC accounting, I did this little note for you. Just remember, in ABC accounting, we use this definition of a cost driver. Yeah? So we're going to be doing the same thing. It's very suitable for assigning traceable service department charges. And we will do a little exercise on this. Yes?
It's like a cost per unit, but for service.
Yeah, I'll show you on the example. Late, why? So common service departments, let me show you some of them. We have payroll and human resources, accounting, copying, we just talked about them, right? Physical plant, order processing, mail, and shipping services. So talking about that cost driver, that's my number of employees. Let's look right in here, right? This is where you would be looking at to try to understand what are we talking about, how are we going to allocate those numbers, right, correctly. Huh? Yeah, so for payroll and human resources, you want to understand how many employees, you want to know how many employees are there, right, so that I can correctly identify my costs. Number of reports prepared, number of copies made for departments, and such and such and such for each of the centralized service departments. So let's look at the numbers. How does it look like? So let's say our, again, Smart Touch example, right? We're talking about the same thing. So let's say they incur 40,000. Ben, not only were you late, you're also talking during the class. Come on. So 40,000 per month is what we have available for our operations. All right. So let's just say that traceable services, service costs are 30,000. Okay. So what are we going to do here? We'll take our $30,000 and we'll divide it by 400,000. Why is it $1? By 400,000, right? So what is the 30,000 is my traceable service cost, and what am I taking? What am I doing right now? Okay, this is not a dollar sign. Threw me off for a second. And we divide it by the total number of orders, which is $400,000. Okay? So what do we get? We get a cost per order. All right? I summed up all of my orders, okay, for CD, DVD, e-learning for all my divisions, and I got 400,000. And I also know that my traceable service cost is 30,000. So I took my $30,000, I divided by 400,000, and I got this 0.075 costs per order.
So to get cost per order, you take your traceable service cost divided by your total?
By the total number of all orders, or, well, yeah, in this case, whatever the base, right, that we're using. All right. So let's look just a little bit further. So, okay, we got this cost per order. Great. What am I going to do with this? So the next what I have, so I just put it there that you have this 0.075 cost per order as just given to you. Again, this is not a 400,000. Now we want to apply it to divisions. Okay, so what I did with this number, I plugged it in right here. Okay. So what's happening? Number of orders for each of the division, I multiply by cost of the order, and now I get the service department charge. So what do you see here? Because CD only had 100,000 orders, I have 7,500 as a service department charge. Yeah, makes sense. So the most e-learning produced the most number of orders, therefore their charge is higher. I multiply by the same 0.075 that I calculated by dividing this traceable cost by total number of orders. Okay, but that's not it. So now we know that we know all the charges. The DVD division can further split This is just an example. We just know that the DVD division is producing two types of DVDs, Excel and Specialty. Okay, so that allows us to see just a little bit further. Okay, it's not, there's no other meaning, it's just an example. Just because we have some of the, we have a chance to split it further. Okay, so what am I going to do here? 10,500 is what I found as a service department charge. I also know that there is a 3,500 as a known untraceable cost. So what I'm going to do, I'll subtract it, and I know that 7,000 I can't trace. So how am I going to trace this? I'll take, so my DVDs, the total is 140. So this 140 is what I'm using right here. All right? So I took that 7,000 and divided by the total number of DVD orders. And that gives me a number of 0.05. Okay, so 5 cents per order. Great. Now, oh, it's here. Cool. All right. So what am I going to do with this number again? I plug this 0.05 as a cost per order. I know that 84,000 is the number of orders for Excel and 56 is the number of orders for Specialty. So pay attention. If I sum these two up, I get that 140, right, that we had here. All right, so I take each of these orders, a number of orders for each of the services, and I multiply divisions, and I multiply it by the cost of order. So I get this service department charge that's split not only by the division, but also by the type of the product. Okay, so now I see out of that 7,000, my service department charge for the Excel DVDs is 4,200, and the other one is 2,800. All right. Great, we can calculate all this, but what are we going to do with these numbers? That's going to let me put together this responsibility accounting report. What it does, it shows the result of the segment or division, right? We just went all the way down to the Excel and to the Specialty DVDs. So it allows me to see, just like under the microscope, the results for each division, for each of the segment, right? For which that particular manager is responsible. So if it's a VP responsible for DVD, that VP can split it further and address it with a certain manager responsible for that production line, right? For Specialty or for Excel. All right, so what does it mean here? It means this. So if I were just to look at the division segment margin, all right, just for this division of the DVD, I can split it even further, and I can say, okay, so I know right now my division is composed of these numbers. I have my sales revenue, variable expenses, contribution margin, traceable fixed expenses, product segment margin, right? Common fixed expenses for non-traceable to specific products, and then divisional segment margin. So here's what it's saying to me. Why is it in more details? While I have it for the total company, I can create a very similar table for all of the three divisions, right? In very much of details. All right. So just as an example for you to see how much it helps, right? Okay, so let's look at the example of the Amazon. So Amazon.com expected to receive which of the following benefits when it started its budgeting process? So A is the budgeting provides Amazon.com managers with a benchmark against which to compare actual results for performance evaluation. The planning requires to develop the budget that helps managers to foresee and to avoid potential problems before they occur. And the budget helps to motivate employees to achieve Amazon.com sales goals and cost reduction goals. So which one do you think it is? Yeah? Why do you think it's all of the above? And it helps to motivate. We also said that it helps to motivate. When you see the numbers for the sales that you need to go toward to, you are motivated to work, right? So if it is the 15th of 17th of April and you see that you're not making the goals for the month, you are motivated to maybe try some other ways to do things, right? All right. So what's another one? Hello? Which of the following is the cornerstone or most critical element of the master budget? Good job. All right. So it's not operating expenses budget, it's not budget balance sheet, it's not the inventory. Those are all intermediaries, right? The sales budget is where we're starting from. The budgeted statements of cash flow is part of which element of Amazon's master budget? Is it the financial, the operating, the capital expenditure, or maybe none of the above? Huh? Financial. Good job. It is a part of our financial budget. So which of the following expenses would not appear in Mall Central's cash budget? Is it depreciation? Why depreciation? Good job. Okay, so let's try this exercise. Suppose Mall Central sells 1,000,000 hardcover books a day at an average price of $30. Assume that Mall Central's purchase price for the books is 75% of the selling price if it charges retail customers. Mall Central has no beginning inventory, but it wants to have a 3-day supply of ending inventory. Assume that operating expenses are $1 million per day. One line calculation. What we need to do is to compute Mall Central's budgeted sales for the next week. Next week is 7 days, so you'll be multiplying something by 7. Once you know the answer, let me know. So my average price is 30, sells 1 million hardcover books, 1 million per day. Is the 75% of the selling price relevant to us? Okay, good. Did you get the answer? Someone got the answer? All right. Why is it 210? All right, anyone else? I'm just curious. Anyone else got the 210? So you're sitting with already open answers and you're still keeping quiet. It's like 3 points to you. Why are you sitting quiet? So 210 is the correct answer, right? What we did, we took 1 million multiplied by $30 and then by 7 because it's 7 days, right? So that's your budgeted sales. So second one. Oops, sorry. What are our budgeted purchases for the next week, for the next 7 days? How would we calculate this? So what are our purchases? How do we calculate the purchases? Yeah? Mm-hmm. Okay. Okay, so we calculate multiplied by 75, we get 500,000. That's our budgeted, right? Cost of goods sold, right? So what is next? We got that number. What are we going to do next? 3-day supply? How do I do that?
You need to have a vending in the previous supply vending in the inventory.
But how do I do that? So I have a 1 million per day, right?
You need 3 billion times 0.75. Something like that.
I have average price $30. I have 1 million books that I'm selling a day, right? If I multiply those two, what do I get? If I take $30, so the average price is $30, they're selling a million books a day, right? So 30 million. What is it? What is a 30 million here? All right. So we know that we are assuming that their purchase price for the books is 75% of the selling price. So what that gives me? Huh?
So you had 67.5 because
But you need 3 days supply, right?
so you add 67.5 million to the 157 to get you 245. The way you get that is you do 75% of the 3 million, and then you get 2,250,000, and then you multiply that by 7, and then you get 67.5 million plus 157.5 is gives you.
And do I have any beginning balance? Okay, so let's look at this. This is an important exercise. So here's what you're going to do. You are on the right track. So you were right. First, we're going to calculate the budgeted cost of goods sold, which is sales and multiplied by 0.75. That's the percent that we get from the sales price, right? So the calculations are shown. The next is our ending inventory. We need to have beginning and ending inventory. We know that the beginning is 0, so let's just talk about the ending inventory. Our ending inventory is 1 million books by $30 multiplied by that 75% that we're getting, right? That we're paying of the sales price. And we need to have a 3-day supply. So we multiply all of these to get that ending inventory as an amount, not just as books. You want to have it as an amount, right? So the next, you're just plugging in purchases, cost of goods sold, ending inventory, less your beginning inventory, right? Beginning is the 0, so all we're dealing is with the cost of goods sold and the ending inventory, and that gives you the answer. So as many of you know, that's already uploaded on the Blackboard. Look it up. Okay. Yes, question? No? All right. So another exercise. Let's look, what is the budgeted contribution margin for that week, which is 7 days, right? So how do we calculate the contribution margin?
Sales minus expenses.
Okay. So what is so-called expenses would be in this case? Right? Okay, so we have cost of goods sold, we have our, you said sales, but we are going to be saying it's budgeted sales, right? Budgeted sales minus, okay. So let's calculate this. What is our budgeted sales? We just calculated on the previous. We said it 210, right? And cost of goods sold is our 15 million, whatever that was, number. Just a second. So it's 210 million minus 15.75 million, and that we get 52,500,000. Oh, that is hilarious. Yes, it's 157. All right, well, So for those who were not listening, good luck going over the slides. All right.
So is the answer still right?
The answer is correct. Information technology has made it easier for Amazon. I needed to do that on purpose. More likely, people will listen. Managers to perform all of the following tasks except. So preparing responsibility center performance reports that identify variances between actual and budgeted revenues and costs, rolling up individual units budget into the company budget, sensitivity analysis, or removing slack from the budget. That's right. All right. The last one, the very last one, and we'll go into the next chapter. Yes, we will. Suppose Reader Corporation has 3 divisions, all using the warehouse, pipe sales, and flanges. The total warehousing cost is $40,000. Total warehouse space is 100,000 square feet, of which pipes uses 30,000 square feet, sales 25,000, and flanges 20,000. The remaining warehouse space is used by the warehouse manager. Which of the following is true? Traceable fixed costs are 30,000, common fixed costs are 40,000, traceable fixed costs is 40,000, or common fixed costs are 30,000. How do we calculate this? So first we want to see what 3 are using, right? So we'll sum those up. 25, 30, and 20,000 is 75,000. 75,000 out of it's not saying 100, but this is 100. Oh yeah, it is right here. Out of the 100,000 square feet, that's your 75%, right? So the 3 are using 75% of the warehouse space, all right? So what am I doing next with this?
Divide 70,000 with 4,000.
So do we know how to find common fixed costs? I mean, is that the goal? So maybe leave it for right now. Let's just put it aside, common fixed costs, great. Let's just look at the traceable, right? We're looking at traceable fixed costs here. So is it 30 or is it 40? How am I going to find this? I'll take $40,000 and I'll multiply it by that 0.75 that I just found, right? And that's going to give me my $30,000, right? I'll take all of these 3, I'll sum them up, I'll divide it by the total amount of the square footage, right? I'll get this 0.75, and then for all 3, I'm using the 75 to determine what is the traceable cost. I'll multiply it by that 40,000 that it says warehouse cost me, right? And that will give me this traceable amount of $30,000. All right, so let's go to the next chapter. Let me just see, how do I use this thing? Can I just exit this? I want to exit this thing. Okay, so chapter 23 is your flexible budget and standard costs. Okay. So what we're going to try to do here is explain our flexible budgets and the standard costs. All right, so we have a number of learning objectives that we'll go through. We'll prepare a fixed budget for the income statement. We'll prepare income statement. we'll try to understand what are the benefits of standard costs and learn how to set them. Compute standard cost variances for direct material and direct labor, but this is not it. We'll also analyze manufacturing overhead in a standard cost system and then learn how to record transactions in standard cost and prepare a standard cost income statement. So let's jump right into. Let's look what are the budgets and variances and how do we work with them. So our budget variances is the difference between actual amount and the budget figure, right? The variance is the difference. We use these to operate the business, to understand where are we lacking, okay, to identify where's the weak spot. Then it's also important for managers to know not just the differences, but also why. Why do we have these differences? Why our actual number is different from the budget, all right? And as a bonus, we can identify not just the problems, but also maybe what was leading to this problem, and therefore take actions to resolve this. Okay, so looking at the actual and static budget, just looking at your actual numbers and the budgets, we can see that we can identify this difference, which is a variance, right? The difference is our variance. Okay? So what is this column? If you notice, there's an F and a U, something that's favorable and something that's unfavorable. So each variance is also going to have a characteristics to it. It's either going to be something that's good for us or favorable and unfavorable that's hurting our business. So let's look, how do we prepare a flexible budget for the income statement? All right, so flexible budget is something that we haven't really talked about. And static budget is the same thing, right? We haven't really talked about them. So what is a static and what is the flexible budget? When we talk about the static budget, it's prepared only for one level of sales volume. Okay? It doesn't really change after we develop it. It's static, right? Okay, flexible budget. Flexible budget is flexible to us, right? It differs, it depends on the volume, okay? So it's prepared for several different volume levels. The key aspect is the volume that it's prepared for. And we have, again, the notion of relevant range. So it's prepared within the volume of a relevant range, okay? And interesting that we are separating our fixed and variable costs for the flexible budget. And the variable costs are going to be like a flex in the flexible budget. We're going to be able to modify it. So what is the variance classifications? We just said that F is going to stand for favorable if an actual amount increases our operating income, and U is going to stand for unfavorable when it's decreasing our operating income. Okay, if that effect decreasing our, in fact, is decreasing our operating income. So let's look at the flexible budget and let's look how do we recognize that this is a flexible budget. So to put together a flexible budget, we need to have several things for us available. It's selling price per unit, variable cost per unit, total fixed cost, and the different volume levels within some relevant range. All right, so here we have our flexible budgets for Smart Touch. Revenues, where we show our revenues and costs. So let's look just a little bit in detail. What is it? We have units, sales revenue, variable expenses, contribution margin, fixed expenses, and that in fact affecting our operating income. All right. So how do we identify that this is a flexible budget? We have this by units columns, right? Where we identify different volume levels within the relevant range. So for us, the relevant range is 5,000, 8,000, and 10,000. So we calculate our flexible budget by units here. All right. So we take our sales revenue, 12. Yeah.
What are those three columns labeled? Like break even, and then what would the column to the right be?
Say again? I've heard like 30%.
So the first column would be the break even point, right?
Uh-huh.
Furthest to the left.
Uh-huh.
And what would the 8,000 and 10,000 column be considered? You said that was a relevant range.
Yeah. Don't tie it. Yeah, don't tie it with this. It's just 5,000 operating income is at the zero. Don't tie it to this right now. All right. So what I want you to see is the components of the flexible budget. Okay, and the fact that the flexible budget will have different columns for a number of units, right, that we're working with. So for $12 of sales revenue, we multiply it by 5,000, we get 60. By 8,000, we get 96, and by 10, we get 120,000. All right. Okay. So how do we perform? How do we prepare this income statement performance report? So we'll be using for this our flexible budget. Why do we need this income statement performance report? We want to let our managers know why and where this unfavorable change occurred, or maybe favorable, so that we can grow from this, right? So managers would need to know why variances occurred so that they can not only pinpoint the problems and take correction actions, but also maybe to notice this, what affected a favorable change, right? And maybe increase the effect of it, okay? So managers will divide the static budget variances into two main categories. There are going to be flexible budget variances and the sales volume variances. And the flexible budget variances is a main difference in flexible budget variance cause. The main cause of flexible budget variances is the sales price per unit, the variable cost per unit, fixed costs that are in some way are different than what we planned. Okay, so three: sales price per unit, variable cost per unit, and the fixed cost. And then the other is the sales volume variance. What it does, it increases when the actual number of units sold differs from the amount in the static budget. We'll look at this in more detail in a second, right? So the last one is the sales volume variance, is the volume difference between actual sales and the budgeted sales. Okay, so let's talk about these variances. First, our static budget variance. All right, so what do we see here? We have all the different ways of computing the flexible budget and the sales volume variance. You just need to understand the difference and therefore to be able to compute the difference between two. So when I'm talking about the flexible budget variance, I want you to compare the actual results with the flexible budget, right? For the number of units that are sold actually, right? So what is our flexible budget variance? It's our actual results minus flexible results, right? For the actually sold. Pay attention to this, to the actually sold, right? So I might be using, if I'm using the flexible budget, I might be going to that relevant range and finding what was that flexible relevant amount, right? So 10,000, if I were using that relevant range, it's probably there, right? You remember on the last slide we had the 10,000 column. And for the sales volume, what I'm going to look at is my flexible budget and my static master budget. But it's not the same. It's not the actually sold. Actually sold is only in the flexible budget. where I'm going to look at that one of the relevant range numbers, right? And I will be comparing it to the numbers of units that are expected to be sold, right? My master budget has the numbers that we're projecting they're expected to be sold, right? On my flexible budget, I have an opportunity of going and actually looking what is that number within that relevant range, right? What is that I actually sold, and track it down and see what is my actual result in the flexible budget for the actual units sold. All right. Yes. It's like what? I'm sorry.
Both actually sold, like you sold both additional units, like you subtract one. You are gonna have interior or gonna have single?
What you for both? For which one are you talking about?
That's what I don't understand.
The
Actual results compared to the flexible budget.
uh-huh.
Both say it's for the number of units actually sold. And
Look.
the other one is for the number of units actually sold.
Yes. So your actual results for the number of units actually sold is your actual number. Now the flexible budget, which you remember how it has 3 columns, right? So if I know that I've sold 10,000, right, I'm going to go to my flexible budget and I'll just look at this number right here, right? Right? The other one is going to use, this one is an actual result. It's not from the flexible budget. So there's a difference likely, right? One is the number derived from the budget, but within this relevant range numbers, right? So I'm gonna, if I know that I sold 10,000, I'm gonna go to this relevant range and see, okay, where's that 10,000 column, and use the number from there. For the actual result, I will use the actual results. Yeah? All right. So looking at the picture that I have for you here, our flexible budget based on actual number of results, and the master is the expected, right? So let's look at the income statement performance report. So we know how we calculate all of this. Now let's look, what do we have here? So our column 1, okay, that's an actual result at actual prices. Okay, so pay attention. Budget, right? Sales volume variance, and then we also have budget. This is your actual result for actual prices, right? That's like your derived by you information from your actual sales and such, right? It's nothing projected. All right, so column 1, we have performance report that shows actual results, right? So we have this 10,000 DVDs that are actually sold, and therefore my operating income is 16,000. Great, right? Bless you. Okay, nice. Now, let's look at the column 3. What does this show to us? Flexible budget for actual number of units sold. You'll be doing this during the exam, 100%. Ask questions, okay? So number 3 is the flexible budget for actual numbers of units sold, right? So it's a number that you take, it's an actual number of units sold, but the one that you take from flexible budget. All right, so here we have 10,000 DVDs, great, but we sold 10,000 DVDs, operating income should have been 20,000, okay? Should have been 20,000. It's the flexible budget number. You see the difference, right? So this is our flexible, this is our actual. We see that we thought that it would be 20,000, our actual was only 16,000. Okay, so column 5. What is this column 5?
That was the budget.
That's the static budget, right?
At the beginning of the month. Beginning of the year.
Static is like your master, whatever you do, whatever is the dynamic in your company, right? Usually it's like a quarter or a month. It's not a very commonly addressed and put together because it's a lot of work to put that thing together, right? So what is it? We are saying that we thought we would sell 8,000 units and that our operating income would be $12,000, right? Okay, so what are we going to do here? We said we have two types of variances, flexible budget variance and the sales volume variance. So putting together these three columns is going to allow us to calculate these variances, all right? So what you do, first you put 1, 3, and 5 together, right? Leaving space in between. Now you want to calculate the variance. So we said that the flexible budget variance is the difference between the actual results at actual prices and the flexible budget for actual numbers of units sold. So what you do here, you go and you calculate 121,000 minus 120 is 1,000, and it's favorable, right? Why is it favorable? Because your actual is greater than your flexible budget number, right? So your sales revenue is greater for actual numbers. Now putting together F for you need to understand, is it really favorable or is it not, right? So expenses, here you go. I have actual number greater than the flexible. Should I say it's favorable? No, it's an expense. So I'm putting it unfavorable, right? Okay, the same goes for the sales volume variance. We need to identify what is the difference between the flexible budget for actual numbers of units sold and the static master budget. So I take one, I subtract the other one, right? I budgeted 8,000, but I actually sold 10,000, my actual number from the flexible budget, right? So that gives me 2,000, great. I sold more than I thought I would. Now let's look at the variable expenses. My flexible budget for the actual number that I sold tells me it's 80,000, and in my static budget I had 64. All right, so that's an expense. Should it be good? Not really, right? It's unfavorable. It's my actual number. I'm using, you would think, okay, both are budgets, but one budget is actually using true numbers, right? The one that happened on the market, you really sold that much, okay? So here your flexible is the one that's going to tell you is it favorable or not. You're comparing to the flexible, right? Okay. Oh, all right. I had all these beautiful...
Just because it's an expense, it doesn't mean that it's unfavorable, right? It can be an expense and favorable if your flexible budget was overestimated actually.
Yeah.
Right?
Yes.
Question number one. Question number two, if we were to get something like this on the exam, we're going to be finding just flexible budget variance along with the sales volume.
Yes.
So you're going to give us a table just like that.
Yes.
And it's we sort of calculate.
Yes, but we're not done yet. Okay, so listen. The next steps, you want to see the flexible budget variance and the sales volume variance, right? For that operating income. That's a very big indicator how you're doing with your budgets, right? And against them, right? In the actual, with the actual numbers. So my flexible budget variance is the difference between 16,000 and 20,000. So I see that it's 4,000. Now favorable or not, it's unfavorable, right? My actual is less than the flexible. And I do the same for the sales volume variance. I compare my operating income numbers. So it's 8,000 because it's 20,000 minus 12, and it is favorable, right? Because my flexible for actual numbers is greater. Now I need to find my static budget variance. What numbers am I going to compare? I'll take my static budget and compare it to the actual results, right? It's 16,000, 12,000. The difference is 4,000. Which way you calculate, I don't care. Just tell me if it's favorable or not. It's favorable because my operating income for the actual numbers is greater than the static.